What if a market crash wasn't an accident? What if it was more like an execution? Today, we're going to dig into the day the silver market was brought to its knees and the evidence that suggests this was no random act of financial gravity. On January 30th, investors woke up to an absolute bloodbath. Silver had plummeted 37% in a single day. But here's the thing that was truly unsettling: the silence. There was no major war, no new pandemic, no giant bank collapse to explain it. Just a gaping hole where billions and billions of dollars used to be.
Yeah, this wasn't the market just finding its natural level. As one analyst put it so bluntly, that is not a crash, that is an execution. So in this explainer, we're going to unpack the argument that this was in fact a deliberate, targeted takedown.
To really understand how this so-called execution might have been carried out, we need to look at four key things. First, we'll dissect the crash itself. Then, we'll look at the historical playbook that seems to have been used. Third, the powerful motive behind it all. And finally, the growing fight between paper silver and physical silver.
Okay, so let's set the scene. The date is January 30th. It's the last trading day of what had been an incredible month for silver. I mean, prices were up a staggering 65%. The mood was absolutely euphoric, and then the market opened and the floor just completely fell out.
In just 6 hours? 6 hours! Silver dropped from $121 down to $75. Gold got hammered too, dropping $900. We're talking hundreds of billions in value just gone. The speed of it all was just breathtaking. It was like a coordinated tsunami of sell orders that just overwhelmed everything in minutes.
So what was the official story for this financial earthquake?
Oh, the usual soothing language. It was a healthy pullback, a market correction, the kind of thing they say to calm everyone down. But when you look at the data, it paints a very, very different picture, one that looks a lot more like a methodical, calculated strike.
And here's where it gets really interesting. This event, it wasn't some shocking new phenomenon. It was kind of like the third act in a play that's been running for 50 years, using the exact same script to get the exact same result. Let's take a look at the playbook.
So, to understand the weapon here, you have to understand margin. Think of it like a security deposit on a big leveraged trade. The exchange, in this case the CME Group, is basically the landlord of the market. And if they decide to raise the margin requirement, it's like your landlord suddenly demanding you pay 80% more for your security deposit by the end of the day. If you can't come up with the cash, you're out, you're evicted. In trading, that means you're forced to sell, no matter what the price is.
And that is precisely what happened. In the 6 weeks leading up to the crash, the CME Group hiked margin requirements not once, not twice, but 4 separate times. They just kept tightening the screws, little by little, until the total increase was 80%. This forced countless traders into a corner where they had no choice but to sell everything.
And this is where the pattern just becomes undeniable. Look at this. In 1980, silver was soaring. They changed the rules to basically ban leverage, and boom, the price crashed 80%. Fast forward to 2011. Another historic run-up in price was met with 5 margin hikes in just 9 days. The result? A 50% crash. And now, in 2026, 4 hikes in 6 weeks and a 37% crash. It's the same tool with the same devastating outcome every single time.
So this brings us to the most important question of all, right? Why? Why go to such incredible lengths to smash the price of silver? Well, the answer, according to this analysis, has very little to do with silver itself and everything to do with protecting the US dollar. See, the US dollar's status as the world's reserve currency is really the foundation of American economic power. But when the price of real, tangible things like gold and silver skyrockets, it's like a global report card on the health of paper money. A soaring silver price sends a powerful message that people are losing faith in the dollar, and that's a message the powers that be just cannot allow to spread.
And here's the proof that faith is already wearing thin. Central banks all over the world are dumping U.S. government debt. And what are they buying instead? Physical gold. At a record pace, they are quietly voting with their vaults, choosing solid metal over paper promises. Now, a key player in this whole global shift is China. They have spent decades strategically positioning themselves not just as a buyer of stuff, but as the world's primary refiner. For so many critical materials that power our modern world, they are the gatekeeper. And that includes an estimated 70% of the world's silver.
And just this year, they made their intentions crystal clear. China officially classified silver as a strategic national security resource. They put it in the same category as military-grade materials and slapped export controls on it. To them, this isn't just a commodity, it's a strategic weapon in a global economic war.
Okay, so this leads us to the final piece of the puzzle. This dramatic and frankly widening split between two very different silver markets. The one you see on your trading screen and the one that exists in the real world.
It's wild. On one hand, you have the paper market, where the price is just a number set by futures contracts, and it can be crashed with a few rule changes. But on the other hand, you have the physical market. At the exact same time the paper price was collapsing to $75, government mints had halted sales, and dealers were completely out of inventory. The real, actual metal was becoming unobtainable at any price.
And this just perfectly illustrates the huge geopolitical game being played. While traders in the West were being forced to dump their paper contracts at a loss, buyers in the East, led by China, were using that artificially low price to drain physical silver from vaults and take delivery of the actual metal. One side is playing with paper, the other side is accumulating the real asset, the real power.
The official line for these margin hikes is always risk management or protecting traders. But let's be real, the traders weren't protected. They were absolutely wiped out. This really suggests the goal was never about protecting the players. It was about protecting the system itself, the system built on the supremacy of the dollar.
Which leaves us with a pretty powerful thought to chew on. You just don't orchestrate such a massive, coordinated, and destructive takedown against something that's irrelevant. The sheer ferocity of the attack is maybe the strongest signal you could get of silver's true importance in this global financial endgame.
Ultimately, this whole event shines a massive spotlight on a fundamental conflict. Paper prices can be changed with keystrokes and rulebooks, but physical supply and demand? Well, those are forces of reality. So the question becomes, in the long run, which force is going to prove to be more powerful? The paper illusion or the physical truth?